Okay, so now we're going to talk about this new topic of provisions, contingent liabilities, and contingent asset, which is covered by Ind AS 37. So essentially, the coverage of the topic is to help account for all miscellaneous type of transaction. Let me put it that way, right? So you have specific accounting standards for revenue, for expenses, for sale, for purchase, for employees and business combination, consolidation, and this and that. So there are a number of accounting topics in a way which are covered, but there is like one common, so to say, topic which then provide a recognition measurement principle for all other type of transaction in general, right? And that is what is covered by Ind AS 37, which in a way articulates all types of possibilities for which an organization is exposed to, whether being in the condition of in the benefit or a liability or an obligation. So it provides a framework to say that, how do you account for it, how do you recognize, how do you measure, and what disclosures which are required to be made both for contingent liabilities provisions as well as contingent assets. And that is what we will aim to go through as we in a way discuss this, in a way over next couple of hours. Okay. So when you look at the need for the standard, it's meant by provisions, contingent liability, contingent asset, obligating event, legal obligation, constructive obligation, and onerous contracts. When to recognize and measure provisions is also in a way we will talk about how to apply recognition principle for contingent assets and contingent liabilities, and what are the disclosure requirement with regard to provision, contingent liability, and contingent asset. Is all of that is we will cover as part of this conversation. All of this is covered as part of this standard. So again, the definition of provision itself, why it's being called provision. So um, in a way, because we don't know that how much, with absolute certainty that this is what I need to pay, to whom I need to pay, right? Similarly, a contingent liability, it may or may not be required to be paid. Similarly, contingent asset, I may or may not receive. So this is unlike a financial asset or a financial liability, where you know the counterparty from where you have to receive, how much to receive, when to receive. So there is some definitiveness to a financial asset and financial liability, or a monetary asset or a monetary liability, which is not the case for provisions or contingent liability or contingent assets, or obligating event. Of course, is generally very clear, but how much is the obligation arising out of that event, in a way that results into some measurement, and we will talk about that. A legal obligation or a constructive obligation is an important in a way concept, which is covered under Ind AS 37, which is again different than AS 29. So if you have read about AS 29, that's one area where there is a big difference between AS 29 and Ind AS 37, is around constructive obligation. Then we talk about onerous contracts. So when to recognize and measure, how to apply recognition principle for contingent assets and contingent liabilities, so on and so forth. So very quickly looking at the examination trends, right? So this has been covered under the new syllabus in November of 2018. In old syllabus also this was covered a couple of times. So I think this is a reasonably okay topic, not complex. I think again the principles are simple. If you apply yourself, you will be able to understand this and grasp this very quickly. So four marks are always in the bag if let's say there is a question to come, so it's easy, right? So just kind of focus on key principles, and you'll be able to in a way appreciate the answer, accounting answer. It's more about, how do you go about determining an obligating event. I think that's something which is critical. And then how you get to the measurement, right? And we will talk about all of that with number of examples is what we have as part of this conversation. So objective and scope, and then we'll talk about recognition and measurement. All right. So talking about the objective of the standard is to ensure that the appropriate recognition criteria and measurement bases are applied to provisions, contingent liabilities, and contingent assets. And then information is disclosed in notes to enable users to understand the nature, timing, and amount for such provisions, contingent liability, or contingent assets, as the case may be. In the context of the scope, right, what is covered. So if something which is already been covered in another standard and you go to the other standard, so it applies for all provisions, contingent liabilities, and contingent asset, except those resulting from executory contract, unless the contract is onerous and covered by another standard, such as financial instrument. I talked about it, insurance contract or employee benefits, or contingent consideration of an acquirer in a business combination, or on income taxes, or on leases, or on revenue from contract with customers. So if it is not covered in other recognition and measurement standard, then you come to Ind AS 37. Another exception is the executory contracts, are those contracts in which both parties are yet to fulfill their performance obligation, right? Like you enter into a contract to let's say purchase 100 units of goods A, right? So your obligation is to pay, the other party obligation is to in a way supply the goods, and that is what a executory contract, something which is under performance from that perspective. And we will talk about when a contract becomes onerous, right? Now talking about the recognition criteria. So we understood the objective, we understood the scope, and now we will focus on the recognition criteria for liabilities, obligations, and provisions. So what is a liability? You go to the construct of the standard. A liability is a present obligation arising from past events, right? A liability is a present obligation arising from past events, the settlement of which is expected to result in an outflow of resources embodying economic benefits. A liability is a present obligation arising from past events, the settlement of which is expected to result in an outflow of resources embodying economic benefits. An obligating event is an event that creates a legal or constructive obligation that results in an entity having no realistic alternative to settling that obligation. A provision is a liability of uncertain timing or amount. So what is liability? Liability is a present obligation arising out of past event. An obligating event is something which has already happened in the past, which creates a legal or constructive obligation for what I've done, in terms of my business activity. And a provision is a liability of uncertain timing or amount. That's why it's called provision. Right? If it is no longer uncertain timing or amount, in a way it will become a financial liability, right? That is when it kind of in a way then I have to pay to somebody, which is identified how much to pay, when to pay. It's like a financial liability. Okay, we will talk about at length now each of these individually. A provision should be recognized when, right? So something which is a present obligation arising out of past event. All right, an entity has a present obligation. Now the obligation could be legal or constructive as a result of a past event. So provision is a present obligation. So today I'm under an obligation to pay arising out of past, right? Not for potential future activity which I will do. For example, I want to do a capex, right? That's a future activity I want to do. But for that, you don't need to record a provision. But I've already done a capex for which now I have to, there is a penalty on me because I've done something wrong. That's something which was, you've done the capex, there is a past event which has happened, and hence in a way there is a legal or constructive obligation. Okay, then it is probable that there will be outflow of resources will be required to settle the obligation. What does that mean? That I'll have to cut a check. I have to give some money to settle my liability, settle my obligation, and it is probable. What's the meaning of probable? Probable means more likely than not. Probable is defined as more likely than not, and we will talk about it, right? More likely than not. Okay, more likely than not. And the third is you can estimate the provision. Your obligation can be estimated reliably. As to how much I need to pay is I should be able to estimate it. If you're not able to estimate it, again, then it becomes a more a disclosure event. You don't need to then recognize the provision from that perspective. So provision should be recognized when it is a present obligation arising out of past event, and it is probable that there will be outflow of resources, and you have the ability to measure it, right? Reliability of the measurement. Now, what's the meaning of a present obligation? In general, it's clear there's a present obligation. Only in rare cases, it's not clear whether there is a present obligation. Where it is not clear whether there is a present obligation, past event needs to be evaluated. Okay. So you need to take into account all available evidence, including the opinion of expert. At times, you may need to take some legal opinions as well. Include any additional evidence provided by events after the reporting period. From that perspective, on the basis of such evidence, where it is probable, right? Assuming it's a present obligation and you can estimate the amount, right? Then you recognize a provision where it is more likely than not that the no obligation exists, right? Then you disclose a contingent liability if there is a possibility of the outflow of resources embodying economic benefit is not removed. If it is not removed, then you make a disclosure. Okay. Now, if it is considered to be removed that there is no likelihood of any outflow of resources, then a disclosure event entity need not disclose the contingent liability as well. All right. Now let's talk about the past event. Okay. And we'll try and help understand with the help of your example, right? A past event that leads to a present obligation is called an obligating event. A past event that results into a present obligation is called an obligating event. Obligating event is the event where the entity has no realistic alternative to settle the obligation created by the event. This is the case when the settlement of the obligation can be enforced by law, or in case of constructive, you've done this by demonstrating this in the past, which is also being called doctrine of promissory estoppel, right? Under the Indian Contract Act. What is constructive obligation? Is a doctrine of promissory estoppel. So to say, what you made a promise, even though it's not required contractually, but you have given this impression in the mind of the recipient that this is your obligation. In the case of a constructive obligation, where the event creates valid expectation in other parties that the entity will discharge the obligation, there should be a past event which leads to present obligation and give rise to a liability for which a provision is required. So present obligation arising out of past event, which is probable that there will be an outflow of resources, and it is measurable, right? And it is measurable. Example, in respect of warranty provision, it should be original sale, that you already made the sale. In case of contamination of land, it would be the original contamination. These are the events which has already occurred, which results into a potential obligation. So let's talk about all of this with the help of an example. Air Dreams Limited is required by law to overhaul its fleet of airplanes once in every 4 years. The company finance team is of the view that recognizing the cost when it is actually paid would prevent matching of revenues that is earned over time from these airplanes, as the overhauling cost, which usually consist of large amounts, are incurred occasionally, okay, which is once in 4 years. Therefore, Air Dreams Limited has formulated an accounting policy of providing in its books of account for the future cost of maintenance, which is overhaul, annual inspection, etc., by calculating a rate per hour. The airplanes are in operation and accumulating a provision over time. The provision is adjusted when the expenditure is actually incurred. you are required to determine whether the accounting policy of Air Dreams Limited is correct or not. Interesting question, right? So essentially, this is unique and also in a way is common for some of these sectors or industry. For example, like the airline industry or a shipping industry or refiners or some of these companies, where we are required to actually mandatorily do overhauling of their assets to prevent accidents, to prevent disaster, and also in a way to ensure that the asset continue to run and it's at its optimum capacity. Okay. So the question here is that should I be actually accruing for that cost in advance of me incurring that cost, right? So is it arising out of past event? And that's past event is actually this 4 years, right? But is it an obligating event? The question here is that can I not exit out of this possible liability? That's also a question you need to ask, right? Without paying the liability, right? So when you look at this scenario, essentially in this case, right, this is 4 years which I need to incur, and then also I need to take a decision that I want to continue to operate this asset. It is also possible that, okay, 4 years of now I don't want to operate this asset. I can take this decision, and if I take this decision, then I'm not required to do the overhauling, right? I may decide to sell this airplane at the end of 4 years, and hence I don't want to operate this. I will buy a new airplane, so on and so forth. So there are multiple scenarios. It is possible that I am not going to incur this liability, right? And hence this is not going to meet the definition for which a provision is required. And that is precisely for situations like these, we account for them under Ind AS 16 under property, plant, and equipment by following a componentization approach. And that is where we create overhauling as an additional component. And actually, the total cost of the airplane itself gets divided into two components, right? Let's say total cost of the airplane is 100. You will say how much I'm going to likely incur for overhaul. That becomes a separate component, say 10, and 90 become the other assets. So 90 gets depreciated over, let's say, 20 years, where this 10 gets depreciated, say, over 4 years. So you actually address this accounting nuance through the Ind AS 16 route and not through the Ind AS 37 route. Hence, you're not supposed to actually create any provision for a scenario like this. So a provision is made for a present obligation arising out of a past event. Overhauling does not arise out of past event. A legal requirement to overhaul does not make the overhaul cost a liability, as there exists no obligation to overhaul the airplanes independent of the company future action. That is, a company could avoid the future expenditure by its future action. For example, by selling the airplane, there is no present obligation. So as per the standard, deals with the financial position of an entity as at the end of a reporting period and not its possible position in the future. Therefore, no provision is recognized for costs that need to be incurred to operate in the future. The only liability recognized in entity balance sheet are those that exist at the end of the reporting period, and hence AirDream should adapt the component approach in Ind AS 16 property and equipment for accounting for the overhauling cost. Let's take another example, okay, where there is a probable outflow of resources. Okay, now for a liability to qualify for recognition, there must be not only a present obligation, but also the probability of outflow of resources as well as your ability to measure them, right? Outflow of resources, other event, is regarded as probable if the event is more likely than not, right? If the event is more likely than not to occur, right? More likely than not to occur. That is, it is more than 50% possibility, right? The probability that the event will occur is greater than the probability that it will not. Let's take an example. Awesome Limited, an automobile accessories manufacturer, gives its customer warranties at the time of sale of its product. As per the terms of the contract, Awesome Limited undertakes to make good by repair or replacement manufacturing defects that become apparent within 2 years from the date of sale. From past experience, it is probable that there will be some claims under the warranties, and it is assumed that a reliable estimate of expected outflows can be made. Present obligation as a result of past obligating event, right? The obligating event is the sale of the product with a warranty, which gives rise to a legal obligation. An outflow of resource embodying economic benefit in settlement probable for the warranties as a whole. Conclusion, a provision is required in this situation for the best estimate of the cost of making good under the warranty product sold before the end of the reporting period. So you will not create warranty provision for the product which is yet to be sold. Products which are already being sold and for which they're still in the warranty period, there is a present obligation where there is a probable approach to say more likely than not that there is so much of defects will come which I'll have to make good, right? That is where you decide a reliable best estimate is what we need to make. All right. The use of estimate, right? When we talk about the reliable estimate, the use of estimate is an essential part of the preparation of financial estimate, right? Of financial statements, and does not undermine their reliability, right? This is especially true in the case of provisions, which by their very nature are more uncertain than most other items in the balance sheet. Except in extremely rare cases, an entity will be able to determine a range of possible outcomes and can therefore make an estimate of the obligation that is sufficiently reliable to use in recognizing a provision. Let's take an example. During the year, an agreement is entered between Sonu Limited and its selling agent Monu. As per the agreed terms, Sonu Limited shall pay a base percentage of commission on all the export sales made during the year. So to pay a base percentage of commission on all the export sales made during the year. Also, an additional commission shall be paid by Sonu Limited if it realizes the export incentives. The accounting policy of Sonu Limited is to recognize the export incentive when actually earned by them. For the year 2017-2018, the export incentives have not been received and uncertainties exist whether these incentives will be received in future or not. You are required to determine whether for the financial statements 2017-2018, should Sonu Limited provide for both the base commission and additional commission or not? As a provision, do I need to make the provision for as my payables to Monu Limited? Now, when you look at the solution, what we're trying to say here is that you have to, of course, make a provision for the base amount which I need to pay because that is rising out of a past event for which there is a present obligation. Now, the obligation to pay additional incentive is only arise when I anyway going to collect the incremental export incentives. And if there is an uncertainty on the collectability of the incremental export incentive in itself, then the likelihood that I will pay to Monu Limited, additional commission, it in a way becomes less than probable, right? So in the given scenario, as far as the base percentage of sale commission is concerned, it is a present obligation arising out of past event. The obligating event take place when the sales are made, and also since commission is based on percentage of sale, reliable estimate can also be made. Therefore, the base percentage of sale commission should be provided, right? The base percentage of sales commissions should be provided. Now, in respect of additional commission, it is to be paid when the export incentives are realized. In case of additional, it is to be paid when the export incentives are realized. Export incentives can only be recognized when there is a reasonable assurance that these incentives will be received. Hence, No provision for additional commission is to be made in financial year 2017-2018. So once I get to the reasonable assurance that the incentives will be received, then anyway I'll accrue for the income as well as then I'm going to accrue for a potential obligation as a result of me recognizing the income. Let's talk about executory contracts. Are contracts under which neither party has performed any of its obligation or both parties have partially performed their obligation to an equal extent. Ind AS 37 is applied to executory contracts only if they are onerous. Example of executory contracts, take and pay contract and throughput contracts, right? Now, what's the take and pay contract? That you enter into an arrangement with the counterparty where you say that you can take delivery of so much, and if you don't take delivery, you'll have to pay me so much. So irrespective of you take a delivery or not, you'll have to pay. Of course, I'm stand ready to deliver, right? That is called take or pay. And similarly, that's also a throughput arrangement. What's a take or pay? An agreement is entered into between two entities wherein the purchaser is legally obligated to take delivery of goods or accept services offered by the seller. And if the goods or services are not taken, he is required to pay. In case of a throughput contract, an agreement is entered into between two parties wherein one entity undertakes to pass to another entity an agreed minimum amount of material or services during a specified period of time. Such types of commitment, the entity has entered into, are exempt from the requirement of Ind AS 37. Such contracts are not covered by Ind AS 37 unless they are onerous. Okay, so what's an onerous contract? So essentially an onerous contract is an arrangement where you end up actually making loss at a gross margin level, right? Which is to say that for you to fulfill your obligation, the amount of consideration which you will receive is lower than the amount of cost which you'll have to incur, and you can't avoid executing that contract. So you have to in a way incur that loss, and you know that today. And if you do that, then you'll have to provide for that loss today, right? This is commonly we see in construction contracts, right, where you provide for this under the Ind AS 115 framework as well. So but under Ind AS 37, if it is not a construction contract, outside of that also there are several scenarios where you enter into a onerous contract. So unavoidable cost compared to the economic benefits, unavoidable costs are greater than your economic benefits which you're going to generate. So under the contract shall be recognized and measured as a provision if an entity has a contract that is onerous. If a contract can be terminated without paying penalty, then it is not an onerous contract. Okay, you decided to continue to be responsible and perform, right? That's a different decision. But if if you can exit out of that contract without paying a penalty, then it is not an onerous contract. That means no provision is required. But even though you can contractually exit out of that contract without paying a penalty, but you decided to continue to be in the contract and continue to incur losses, then it is not an onerous contract. You will keep on recording losses as you incur. Then there is no present obligation arising out of past events, so to say. Okay, and hence no such provision will be required. Let's take an example. A1 Limited enters into a non-cancelable contract with B1 Limited. As part of the contract, A1 Limited agreed to purchase from B1 Limited 50,000 units of raw material at INR 100 per unit at a contract price of INR 50 lakhs. Okay. The terms of the contract also provides that A1 Limited shall pay a penalty of INR 12 lakhs if it exits from the contract with B Limited. There's a penalty. During the year, A1 Limited discontinued manufacturing the product that uses the said raw material. To avoid the penalty from the contract, A1 Limited has identified a third party to whom it can sell the said raw material at INR 80 per unit. So I've agreed to purchase, right, 50,000 units, 100 per unit, and if I don't purchase, then I have to pay a penalty of 12 lakh rupees. Now, during the year, I decided to discount the product that was using the said raw material. That means I no longer need that product. But if I were to exit, I have to pay a penalty of 12 lakh rupees. And then, but I figured out there's a buyer of this raw material whom I can sell at 80 rupees. So essentially, I have to buy at 100 and I'm selling at 80. So I'm incurring a 20 rupee loss on every piece of this product which I'm buying. So my total loss is 10 lakh rupees, right? In respect to the above contract, how should A1 Limited account for this transaction in the book of account? So my loss because of this alternative arrangement is 10 lakh rupees, whereas otherwise I have to pay 12 lakh rupees. So how much is my loss, which I am not able to avoid? That is 10 lakh rupees. That means I have to make a provision of 10 lakh rupees. The circumstances indicate that it is an onerous contract. The only benefit to be derived from the purchase contract costing INR 50 lakhs are the proceeds from the sale contract, which will be INR 40 lakhs. Therefore, a provision should be made for the onerous element of INR 10 lakhs, being the lower of cost of fulfilling the contract and the penal cost of cancellation of INR 12 lakhs. Now let's talk about the distinction between the constructive obligation and the legal obligation. Okay. Two types of obligation. Legal, something which originate under law, right? Or by contract, legislation, or other operations of law. A constructive obligation is something which originate because of established pattern of past practice, published policies, sufficiently specific current statement in a way, or other parties that certain responsibilities are accepted, which is again I was saying, right? You create a valid expectation in the mind of the recipient. That is called a constructive obligation. Legal obligation, something which arising because of the contract or the legislation or other operation of law. Let's take an example. Sunny Limited and Bunny Limited entered into a contract for supply of material Y. As per the agreed terms, in case of breach of contract, the party that breaches the contract shall pay INR 2 lakhs, INR 2 lakhs to the other party. During the year, Sunny Limited breached the contract with Bunny Limited. Good. In this case, the obligating event is the breach of contract, which shall give rise to present obligation that Sunny Limited will settle with Bunny Limited. That Sunny Limited will settle with Bunny Limited. As per the terms of the contract, the obligation arising on breaching of the contract is a legal and contractual obligation. There's a breach. That's a binding arrangement between the two parties. So the obligation arising of breaching of the contract is a legal and contractual obligation. Now let's take an example of a constructive obligation. Bruno Limited is operating in the oil industry. And so this is an example of a constructive obligation. Bruno Limited is operating in the oil industry and currently working on a project in the country where there are no environmental legislation. During the year, the entity has caused contamination on the project site. Though there are no environmental legislation in the operating country, Bruno Limited has a widely published environmental policy in which it undertakes to clean up all contamination that it causes. Bruno Limited has a record of honoring this published policy. It is assumed that a reliable estimate can be made of any outflow expected. The entity year end is 31st of December. The present obligation as a result of a past obligating event. So this is something is a present obligation. The obligating event is the contamination of the site which give rise to a constructive obligation, and by conduct of the Bruno Limited to clean up all the contamination, the entity has created a valid expectation on the part of those affected by such contamination. An outflow of resources embodying economic benefit in settlement is probable. Conclusion: a provision is recognized for the best estimate of the cost of claim. Yeah, it's very clear. So we talked about a legal or a contractual obligation, and that is where there was a breach, and this means a provision is required. There's an example of a constructive obligation, even though there is no law, but you have created an expectation with your conduct that this is what you will do, this is what you've done, and the event has occurred. You need to record the provision. So now we're going to talk about the contingent liability and contingent assets. So we've already talked about constructive obligation, a legal obligation, the provisions that when you need to record a provision, it's arising out of a past event, right? Something which is probable and you can make a reliable estimate. And then we looked at several scenarios and when it is coming out of legal or constructive. Now let's talk about contingent liability and contingent asset, right? So the definition of a contingent liability and a contingent asset. What is a contingent liability? Is a possible obligation. It's not probable, it's possible. Obligation arising from a past event to be confirmed by future events, not wholly within the control of the from a past event to be confirmed by future events, not wholly within the control of the entity, or present obligation arising from a past event of which the outflow of economic benefit is not probable, right? Or that cannot be measured with sufficient reliability. So again, if it is a present obligation or a possible obligation, outflow of which is again you're not able to assess it appropriately. A possible asset, contingent asset, is a possible asset arising again from a past event, and its existence will be confirmed by future events, not wholly within control of entity. Let's take an example. P Limited has a pending GST case before the Honorable Court. In this scenario, the liability for payment arising or not to P Limited shall depend upon the outcome of the court decision. Is a possible obligation that arises from past event and whose existence will be confirmed by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of P Limited. If it becomes probable that an outflow of future economic benefit will be required in the above case based on your own assessment of the merits of the case, a provision is recognized in the financial statement of the period in which the change in probability occurs. Let's look at another scenario and the example. Tommy Limited has filed a legal suit against Blue Toe Limited, supplier of the goods, for compensation against damages caused due to non-supply of contracted goods within the agreed timeline by Blue Toe Limited. So there is a legal suit, right, for non-fulfillment of performance obligation. So there is a possible asset, right? So now you look at accounting for Tommy Limited, there is a possible asset arising from past event whose existence will be confirmed by, so this is an example of a contingent asset. Okay, confirmed by the occurrence or non-occurrence of uncertain future event. And similarly for Blue Toe, it's a liability, right? On wholly within the control of the entity, the income arising out of contingent asset may only be recognized if there is a virtual certainty. Unlike a liability, where you focus on probable, here you look for virtual certainty of the realization of income, which is like 95% type certainty, okay, of realization of income. So again, talking about contingent liabilities is a present obligation resulting from past event, in a way for which outflow of resources is not probable or reliable estimate can't be made. A possible obligation depends on future event. Outflow of resources is possible, reliable estimate can't be made. Contingent liability, we got to disclose only. If it is outflow is remote, then we have to do nothing. That's the quick, in a way, recap of what we talked about on contingent liabilities. Again, looking at an example, Good Health Limited, a pharmaceutical research and development company, is operating in close proximity of a river for the last 30 years. The local public residing near Good Health Limited has claimed that R&D operations has caused serious contamination of river drinking water. In this regard, Good Health Limited has also received notice from the governmental environmental agency that official investigation will be made into claims of contamination caused by the company. And if it is found that Good Health Limited has caused such contamination, then penalties and fines shall be levied on the company. The management believes that it has implemented all environmental safety procedures to an extent that it is unlikely to cause contamination. Also, the management is not sure whether it has all the information about the entire 30-year. Therefore, neither management nor the external experts are able to assess Good Health Limited responsibility until the investigation has completed. In this scenario, you're required to determine how should management of Good Health should account for the liability. So it is like arising out of past event, but I'm unable to make judgment about the potential claims which I may need to entertain. And that will only be known possibly once the investigation is complete, right? So that is why it will be a disclosure event. In the present case, the available evidence does not support a conclusion that a present obligation exists. However, there is a possible obligation which exists and will be confirmed upon completion of investigation. Therefore, management should disclose the contingent liability for potential penalties and fines that may be imposed if contamination is proved. Okay, let's take an example of a contingent asset. It's a realization of income. It is virtually certain. Recognize that as an asset. Okay, inflow of benefit is probable or not probable. It's a depend upon disclosure event, right? Contingent asset only disclose. Not probable, do nothing. If it is probable, disclose. If it is not probable, do nothing. Okay, let's take an example. During 2018-19, Sun Limited and Moon Limited entered into a contract for INR 6 crores. As part of the contract, Sun Limited is required to sell raw material X1 to Moon Limited. The delivery of raw material X1 is to be made within 4 months from the date of the contract, In case of failure to deliver within the said timelines, Sun Limited shall pay a compensation of INR 60 lakhs to Moon Limited. During the transit of raw material X1, the vehicle met with an accident and Sun Limited lost the entire consignment. The consignment is, however, covered by an insurance policy. According to the report of the surveyor, the amount is collectible subject to deductible clause, 20% of the claim in the insurance policy. The cost of the good loss was 5 crores. 5 crores. Before the financial year end, Sun Limited received informal information from the insurance company that the claim has been processed and the payment had been dispatched for 80% of the claim amount. Meanwhile, Moon Limited has made demand of INR 60 lakhs since the goods were not delivered on time. Now you are required to compute what is the amount of provision or disclosure that Sun Limited need to make at the end of 2018-19. So when you look at this, as per the standard, where an inflow of economic benefit is probable, an entity should disclose a brief description of the nature of the contingent asset at the end of the reporting period, and where practicable, an estimate of the financial effect measured using the principle set out in Ind AS 37. Therefore, Sun Limited would need to disclose a contingent asset of INR 4 crore at the end of the financial year 2018-19. It need to make a provision of 60 lakhs towards a claim as raw material is not delivered, and also, of course, the loss of raw material itself, right, of 5 crore. That also will be charged to P&L, right? Loss of raw material of 5 crore. That is also charged to the P&L. Now we believe, so that's what is written, of course, in the ICI material. Here we believe that, that the contingent asset can also be recorded as it is virtual certainty. The check's been processed, been given, and anyway, I'm recording a loss here, right? 5 crore loss. So essentially, there is no gain which I'm here recording. I'm just kind of recording a recovery of a loss which I've already charged to the P&L. and the checks already been dispatched and so on and so forth. So but we've kind of retained the answer as written in the ICI document. So if you look at the range of possibilities and probabilities, so if the likelihood of outcome, whether it's an asset or contingent asset or a provision or a contingent liability, virtually certain is greater than 95%, recognize the asset, recognize the liability. Probable is more than 50%, less than 95. It is, there's also something called highly probable, which is again more than 80%, 70%. Disclose about the contingent asset, recognize the provision, possible but not probable, which is 5 to 50%. No disclosure permitted, disclose the contingency, remote, less than 5%. No disclosure, no disclosure. That's a quick, in a way, summary of different range of possibility. So to recap what we have talked about so far, liability is a present obligation arising from past event, the settlement of which is expected to result in an outflow of resources embodying economic benefits. Provision is a liability of uncertain amount or timing. Obligating event is an event that creates a legal or constructive obligation that results in an entity having no realistic alternative to settle their obligation. And we talked about what is contingent liability and contingent asset. Contingent liability is something which is present obligation, but you cannot do a reliable estimate, okay, or a possible obligation, right? To be confirmed by future event, again arising out of past event, from that perspective. So wherever you cannot make appropriate determination, you have to look at the probability and then do sufficient disclosure. Contingent asset, possible inflow of resources, again which is not virtually certain, then you'll have to make disclosures, provided they are more than probable, then you make disclosures. Now we're going to talk about the measurement principles, and I'm going to take a pause. Nitin, एक बार इसको कर ले, एक सेक्शन कंप्लीट हो गया ना, आधा हो गया.